Welcome to YXI Insights. This is Yimin. Today, we're going to provide our weekly market update. We're going to first go through the FOMC projections for the next 12 months. We're going to then look at the YXI quantitative model signals for the past couple of days to gauge where the market sentiment is. And we're going to look at the chart analysis for SPY, QQQ, TLT, US oil, Bitcoin, MSFT stocks, gold, and SOXX. So let's begin. We use the Fed Fund futures market to derive where the market pricing is for each FOMC meeting, the probability of a cut or a hike from the market pricing of each meeting. So looking ahead, the market essentially prices in a minimum of 3 cuts in the next 12 months, with the option of a 4th cut by June 2026. And this is largely according to the latest FOMC dot plot as well. So the market and the Fed are in agreement here. The risk of paying for the 2-year bond here, i.e. receiving the yield, is the negative carry. What do I mean? So if you buy a 2-year bond and the Fed decides that they are actually still in the wait and see mode for longer than they previously thought and doesn't cut rates at all this year, then the bond prices will drop because the yields will be revised higher for the future projections. So that's something investors need to consider versus just locking in the bond price in the 2-year yield at the current level. And what we see is that the Fed doesn't think there's going to be a recession. The Fed doesn't think unemployment rate is too high. And the labor market does appear pretty strong. It's recorded consecutive 6-figure jobs added every month for the past few data points. Unemployment rate at 4.2% is well below the Fed's essentially red line of 4.7% that they projected for the end of the year. And inflation is moving towards the Fed's target, but still not within the target range yet, which is 2% for the PCE. So given all of this above, the Fed much rather wait and see in case there's inflation resurgence from the tariff policies. There could be a lag, it could be more sustained than what policymakers think, etc. Or there could be a recession. At the moment, the chance of a recession is quite small. So the Q2 GDP is on track to grow by 2.2%, according to the Atlanta Fed. So for a recession to happen, assuming that the Q2 GDP is expansionary, we're looking at potentially consecutive contractions in Q3 and Q4, which of course is quite a stretch right now. So given all of this above, the picture is uncertainty, but not recessionary just yet. Looking at our model signals, so we use machine learning signals for all of these individual tickers by themselves. So the machine doesn't know what the result is for SPY today versus Google or PLTR. And our backtests have shown very promising Sharpe ratios and very small drawdowns in a large sample period of 1,000+ days. So for the past couple of days, the machine is essentially saying risk on for risk assets. Buy risk assets, which is SPY, QQQ, Bitcoin, MSFT stocks, and PLTR, and stay away from bonds. So in the broad scheme of things, our machine has been pretty good catching this risk-on wave since first launching the Bitcoin service and the Tesla service in mid-April, but also all the other tickers in May. And what it really means is that you could follow this very religiously and say, 1 is keep position on, 0 is position off, go into cash, etc. Or what I like to do is use this as part of a more holistic analytical tool for assessing the market sentiment on any given day, alongside fundamentals, valuation, and also technical analysis, for example. And the models have done, I would say, pretty well since the launch. So this is the cumulative returns. We publish this every Friday in our newsletter, but also on this video. The best performer is by far Tesla. We launched Tesla model just before the earnings. So there was a massive risk that the earnings could have sold off. But we're lucky to have actually caught the move completely from the post-earning rally up until today. And so Tesla, the model would have returned us 45% if the investor followed this signal religiously. Bitcoin is also another big gainer, 26% since mid-April, which is pretty decent. It's essentially been catching the risk-on wave since the launch, which at the time was 84K for Bitcoin. And of course, SPY, QQQ, these were launched in the past 2 or 3 weeks, but 5-6% return is pretty good given how the market has been this year. Amazon done pretty well. We've had a little bit of a back and forth with the signal in the middle of the month, but overall, is 8% is pretty good, I would say, given just 1 month work. So now looking at the live charts, SPY. So we are going to look at a bit of a high level development here. We've had a trend line that had been supportive of SPY up until February that was broken. So that is likely to act as our next resistance level. And that coincides with the all-time high here. My personal belief is that we are more likely to see a new all-time high than seeing a new low first in 2025. We may see this all-time high and then see and then the market retreats, etc., after this final wave 5. But I do think the near-term path of least resistance is moving higher. Unfortunately, the market is taking a little bit of time digesting this price level here. So if you look at the current level, we're on 590. That's been a hot level throughout November, January, and Feb. Right? That's been the level people are buying the dips, hoping that the market will go down, and they were eventually disappointed because the market sold off in February. So we're back to this level. A lot of people have had bought back here. What do they want to do? They're now break even. They're like, well, do I really want to be greedy and chase the next 4%? Or do I want to offload some risk here in case the market turns? And this is precisely at the 1.236 extension of this first rally here. So I think a lot of people look in the technical levels and say, okay, I want to offload some risk. This is why you're seeing this large volume profile building at this precise moment. So in the very near term, we're seeing market digestion, trading on headlines, trading on option puts, etc. People trying to get more protection as we approach this highly contested level. But ultimately, I do think we're going to climb the wall of worry and make a new all-time high. If not straight away, then a wave 4 retrace and then wave 5. So that's my base expectation for SPY. In terms of timing, I would say that I expect this wave 3 to be achieved before the non-farm payrolls. Why? June is typically a weak month for equities, especially the second half of June. Next week, which is non-farm payrolls on Friday. So going into Friday, I think that will be our last chance to push for this wave 3. And then for June, we can see a seasonally weak correction for wave 4 before we get onto the wave 5. So that's my, just combining with the seasonality and the macro expectations, that would be my base case. And non-farm payrolls would be a very good catalyst if, let's say, the figure comes in a disappointing manner, adding fewer jobs than expected, etc., or the unemployment rate takes up to 4.3 or 4.4%, but unlikely 4.4, but let's say 4.3%, and that could give people some impetus for sell-off. So I think that timing and the catalyst works well for a turning point at this resistance level. If we look at the big picture for for QQQ as well, we have a pretty well tested trend line here, which was broken in February. And QQQ on a relative strength basis in terms of Fibonacci levels has done better than SPY. So it's made a new high yesterday at the open compared to the rest of May. We're very close to the all-time high, and we are essentially at the tip of the 1.382 extension of this first wave. So given the clues we're seeing from QQQ, I do think SPY, because they're very heavily correlated, will also move up in a 5-wave fashion. So that gives us the minimum target already, QQQ, for this wave 3. And I think QQ could potentially roll over a bit sooner, or maybe it will just consolidate into the end of next week before the wave 4 pullback in June. So QQQ has done better, but if you look at the price action just at this level, that's been very strong. So this VWAP is taken from the February high. And just so it's only accounting for those candles here and those candles here. That's already been the largest volume profile for the single price region compared to the rest of this sell-off and bounce. So there's a lot of, it's essentially a stalemate between the bulls and bears at the current price level. But because of how far it's rallied relative to this first wave, I do think we're in a bull market rather than a bear market. So for USO, I think the trend is a very bearish one. It wasn't very obvious up until probably beginning of April when we made a new low here. But if you look at the broader trend, we're seeing lower lows and lower highs since November last year. And we're likely in the wave 5 of this trend. And it seems that wave 5 would probably have 5 waves here. So it's the more extended leg of the 5 waves. The reason for this bearish outlook is both fundamental and technical. OPEC is scheduled to increase their production supply throughout this year. And we're seeing increasing supply from non-OPEC countries like US and Canada. We are also seeing hints of potential deal making between US and Iran, which will increase the supply in the Middle East. And given the Russian-Ukraine situation, which is not fully priced in for a peace deal yet, but if that peace deal does arrive this year, then some of the sanctions for Russia will reduce, at least for the vessels, and Russia could be producing more supply anyway. So on the supply side, there's a lot of oil coming onto the market this year. But at the same time, the demand is waning. And this is from both the fundamentals. There's a lack of economic growth. There's also a wide adoption of electric vehicles in China that has been faster than what the economists had predicted. And overall, it's not that clear how the actual supply will get digested by the developed countries. And in fact, developed countries are needing less oil this year than last year. Now, turning to yields, and I think it's now quite apparent we are in an upward trend for yields. So the 30-year yields, we've made higher highs and higher lows since essentially July last year. And it's actually still at a pretty elevated level despite the global bond rally, with 30-year at 4.93% today. My expectation remains that the 30-year yield should move to 5.3% to 5.5% as a minimum expectation in the next move. And I think there's a very good chance that it will breach 6% later this year or even 2026. So I would not be a buyer here for this reason in terms of bonds. And given what Elon Musk and Scott Bessent have said in the recent interviews, I think their plan have really switched from cutting the budget deficit, trying to restrain federal spending, uh, into just trying to grow the economy. And with the goal of growing the economy by 3% each year to reduce the overall debt to GDP level, I think they might actually have to increase fiscal spending to spur growth. That could actually get investors quite anxious about the risk premium they should assign to bonds, and fiscal discipline, etc., in the next couple of years. So I don't think the investor worry about bond yields will go away anytime soon. So I am quite cautious buying bonds at those levels just yet. With TLT, it's the same. We're in a downward trajectory since July last year, lower highs and lower lows. And I do think we can visit the 80 handle, and even below this year. So on the margin, I think bonds are quite bearish right now. What could change my mind? Well, if we manage to move back towards 90 and break above this 200 EMA, that could be a game changer. But right now, that goal seems pretty distant, just from looking at the technicals. So looking at GLD, we completed the ABC correction 2 weeks ago, and that this could be a larger degree of wave A of a flat. And now we are likely in a wave B bounce. And with wave B bounce, wave Bs tend to have three waves. And so we've seen wave A complete, and we could be getting wave B soon before a higher wave C. I don't think wave B has completed, so this low here is quite shallow. I do think we should get a lower retrace down to below 300 at least to finish this wave B. But the situation is quite fluid, so we're going to watch. I'm not in the mood to either play this bounce or short the gold here. Wave Bs are very difficult to trade and very unreliable. I much rather get the right signals for wave B than before thinking about a further downfall in a large degree wave C. For Bitcoin, what we have seen is very shallow pullbacks since the April 8th bottom here. We've had wave 1 and wave 2. And I do think we're nested with 1, 2, 1, 2 here. And the larger degree wave 3 could be in the 123 region as the first target. If we just look at within this large degree wave 3, and we've had a wave 1, 2 here, then the wave 3 correspondingly should be 116K plus. We haven't really quite got there. We've got to 112K and it's reversed down. So right now, this could be the beginning of a larger degree reversal, in which case this is not a nested a wave 1 to 1 2. It's just simply a wave 3 and 4. But just looking at global liquidity, we should have a much more extended rally than just topping over here in this cycle. I have learned to be a bit patient with those pullbacks, as long as the overall momentum stays healthy. I think we haven't had many leveraged loans going bust just yet. And in fact, it's the short side, the leveraged shorts that got busted during this upward move. And there's been very healthy fund flows in IBIT, which is the BlackRock Bitcoin fund. So overall, my read for Bitcoin is still very positive. I would just like to show you this G5 money supply chart versus Bitcoin as well. So just looking at a 3-month lag with this G5 M2 money supply versus the Bitcoin price. We topped on September 30th for the money supply, which was the top for Bitcoin December. And we had a bottom in the money supply in January, on January 10th, which corresponded in a bottom. So the real bottom for Bitcoin came a week later in April, accounting for the 3-month lag. And now we're at this junction here. We could see a short-term correction before a much larger move up as the global money supply makes new highs. And granted, all of this, most of this move is not just because the money supply has been expanding, which it has. A lot of it is because of the dollar's weakening. And that is still a very real change in the money supply. Why? Because most of the global assets and debt and collaterals are traded in US dollar terms. And first, Bitcoin's traded in US dollar, BTC, USD. So higher dollar is a headwind for Bitcoin prices by default. But also when dollars amount decreases, that makes the global bonds, national bonds, high-grade credit, FX swaps, etc. All of the value of those assets being used as collateral go up as well. So that means more liquidity in the system, and therefore that is supportive of risk asset pricing. And Bitcoin is being very sensitive to that. And you can see this lead is much shorter for gold, but that also did propel gold into new highs earlier in the year. So I would say on the balance, is it worthwhile just trying to stay out of this correction? For example, this correction could be much steeper in terms of its translation onto Bitcoin level, or just ride the wave. That's up to the individual investor, depending on how confident with the timing, transaction costs, etc. But in terms of broader thinking, the next 2 or 3 months, I do think Bitcoin has a lot of room to go. Looking at Apple, so Apple has managed to stay above this wave 2 low. It actually matched the level, but stay above this wave 2 low and also this wave 2 low. So that's the nested 1-2-1-2 for me. I do think Apple is in a still has its tailwind. Is going to move higher before it moves lower. So to invalidate me, the test is quite simple. Get below this wave 2, and maybe we're looking at a lower low here as an ABC correction. But my primary expectation right now is that it should be on track to this broader wave 3 target of 250. It doesn't feel like it because 2 things. Apple is post-growth. It's growing at low single digits. It hasn't really made innovative products that are sticky to use. For example, the Apple Vision Pro that was launched last year, pretty fantastic products for first-time users. But it's not sticky because we haven't seen loads of people buying it with a sustained volume into this year. And people are not really raving about it anymore. A lot of feedback has been, it's just collecting dust. So maybe the eyewear technology is still too early in its infancy. I know Meta is also trying to push similar AR, VR products. So that hasn't really worked out. And also it's getting very tough competitions in China with Huawei and Xiaomi, which are priced similar and sometimes cheaper in terms of competition. And Apple Intelligence is really not that great compared to what Google, for example, has to offer, or Samsung. So the fundamentals are not on Apple's side, but Apple has $100 billion in its cash pile to repurchase stocks. And that has been, by and large, was helping the stock price in the past 5-6 years. So I wouldn't fade the stock. I do think the stock will come back based on just the share repurchases alone. But it has to pick up growth from either new products or more competitive strategies in China. Also, it's facing headwinds in terms of tariffs right now, which could be cancelled by the US court. But essentially, Trump has threatened to put on 25% tariff tax on Apple if they don't produce the iPhones in the US, Apple may decide to just bite that bullet, and it will reduce the gross margin by a few percentage points, but they can afford to wait out Trump and wait for the new president, or wait for a broader tariff reversal as we go into the midterms next year. But the game theory also dictates that if Apple does apply that strategy, then Trump could threaten to put on 50% or 100% tariffs until Apple blinks in the near term. So that essentially puts investors off. So I would say broadly, it should be moving higher on the stock purchases, but it's not really that compelling as an investor case from a company business fundamental point of view. Amazon, I do think it probably has completed this wave 4 now, and we're looking at this wave 5 bounce next. Wave 5 could be 223 to 230, which is essentially the 1.382 to 1.764 inverse extension of this wave 4 here. So the inverse extension of wave 4 from this wave 3 high. These are the typical targets. Of course, could extend the run, but I do think the near term path is higher. And especially if you're looking at, in terms of technicals, we've made past this wave B high. We've got a heavy accumulation of volume over here. So once we take off, move past 210, for example, I think Amazon can quickly move to this 230 target, given the lack of volume resistance in this region. Google, if I can use one word to summarize Google's technicals, which is indecision. Indecision because we made intraday high here, which is the 138% extension of this first wave. So technically, this could invalidate the bearish 3-wave expectation for wave B, but that was intraday high that didn't really close meaningfully above this level. So we're still very tentative with the alternative count. And Google has traded sideways essentially in the past week, 5 candles, just in this very tight region, the 170 low 170s. And we're seeing volume being built up here. What I really want to see is for Google to move above 177, decisively close above it, and we can start thinking about maybe the wave 4 pullback and wave 5. And actually, this is an ABC, very shallow wave B correction down here rather than 5 waves. Unfortunately, the pattern hasn't been that clear for Alphabet since this February high. We didn't really get meaningful pullbacks. That is a better placed wave B, etc. But which means we have to get more signals down the line in this rally to deduce what the past patterns are. In this period of uncertainty, I'll just wait and watch. There are better trades out there, essentially, than to chase this one right now. Meta, I like Meta's technicals. We got wave 1, wave 2, wave 3, and wave 4 pullback. That looks to be finished now. It's shallower than I would liked. But the wave 5 target could be 680 to 700 level here. We have heavy volume building here, but Meta already traded past this wave B level, which is very bullish. And I think wave 5, we can easily get to this wave 5 as the next move. But of course, if we think about what happened with SPY and QQQ, we do want this next week to come in strong and just get to this level straight away before thinking about the next pullback. But broadly speaking, I do think the Max 7s are still well positioned for higher highs here. Microsoft, after the earnings gap, we haven't seen any signs of pullback. We launched our signals just around, I think, maybe the 5th of May, so after the earnings, with the big risk of this gap still. But the signals have insisted on a signal of 1 since launching, and we've basically been catching this small rally between post-earnings and here. And this rally is quite extended. In terms of wave 3, we're looking at the 200% extension of this wave 1. So decisively, we're in a 5-wave impulse rally. The question is, when do we essentially finish this wave 3 and wait for the wave 4 pullback? I probably wouldn't chase it here. I would wait for Microsoft probably to reach this 467 level, and then I'll wait for pullback before we decide on the wave 5. NVDA, we've had all 5 waves completed or near completion now. So wave 5 was reached at the target. The target for wave 5 was reached at the open yesterday at the 138 extension for this wave 1. So that typically completes wave 3, but it could obviously stretch to here 151. We had been expecting this level for a while, and it's played out according to our expectation, which is great. Question is now, are we going to see a wave 4 retrace straight away, or is it going to extend? I'm probably not going to chase it here. If I was not long already, I'm probably not going to chase it here. I could hold personally if I was already long and just wait for this final wave to fill out more into this 1.618 extension. Given where we are now, if wave 3 has ended, then I would expect a pullback in wave 4 to be in this 123, 130 region, which is the 200-day moving average. So that's a nice retest. So I would be inclined not to overtrade this, or essentially just do nothing and wait for the next pullback and then wave 5. And if I didn't have a position, I would probably wait for this pullback to complete, wait for this 200-day moving average to be tested, and then play the final wave 5 long. Tesla was up 50% from this low point, and against many people's surprise, to be honest, because when we were stuck here, everyone's saying the brand is finished, Elon Musk is done, Tesla as a stock is ended, but then it's rallied back much faster and higher than where people had expected over here. I've definitely seen people selling down here to say, we don't believe in the stock anymore, this company is done. That's often a bullish reversal sign when you see everyone being absolutely bearish to the max, and even long-term holders giving up on the stock. Right now, I do think we've had wave A and shallow wave B pullback, and we're entering the end game for wave C. Wave C is almost there in terms of the minimum requirement of 100% extension of wave A. That would be 370. And it could extend to 400, which is the 1.236 extension of this wave A. So we didn't quite get there yet, but my expectation is we probably will get here next. So I'm not overly concerned that we've topped already, but once we get into this region, I don't think chasing would be wise, because even if you think that the market can go much higher because of the global amp, which we'll see in a second, it's worthwhile just seeing how the price action evolves in this region here. And if you just look at the chart holistically, it's been a very mirror imaged move, or V-shape recovery. So we do get a lot of volume up here again in this region. People who are buying the dip because we just made a new high. People thought, oh, we can buy this dip here, but they got disappointed, got trapped, bounced here, offloaded some risk, but then got further trapped here for those who thought this is another dip. So as we approach here, we're seeing heavy volumes accumulating from the prior moves over here. And there's a risk of people who bought here, who got disappointed in the traps, now de-risking as they break even at 400. So we really want to see how the price action evolves between 370 and 420 region, and whether we get a retrace. And if we do, get moved past this point, so that could be invalidating this wave C, and we get a wave 4, with 3 rally here. We can always then reposition ourselves after the wave 4 dip. So that's kind of how I would see the risk reward going forward. In terms of global M2 levels, very similar to Bitcoin, even though Tesla hasn't made back its all-time high or its new high here. We are seeing a potential weakness period in June again, but the overall trend is favorable. There's a very good chance we get invalidating in this wave B. I would just say that once we get into this box, it probably pays off to kind of wait and see how the price moves before loading up the truck, as it were. SOXX. For SOXX, I do think this wave 4 probably has ended. It's retesting the 200-day moving average again, and we're probably in the wave 5 area here. It moves with NVDA, but doesn't quite because it has other stocks as well, for example, AMD. And so overall, SOXX hasn't been as bullish as NVIDIA on its own. And we do have this medium-term resistance from this July high that needs to be cleared. So, and in terms of volume, we have a volume profile building here from those buyers here. So I do think we're probably in wave 5, but it will just take a while to get through all of this resistance. So it's probably one for the patient investors. Not my personal favorite wave 5s, just given in terms of the volume, the obstacles we have to clear. But on the margin, I'm probably on the bullish side here. So that's it for today. Thank you for joining today's market update. I hope that was useful. Any questions, please leave them in the comments or on Slack or on X. So looking forward to next week. Thank you.